You're listening to the Seed to Exit podcast with your host, Reese Keck. Here you'll learn from startup executives, founders, investors, and industry experts. You'll learn from the best about building amazing products, scaling companies, raising capital, hiring the right people, and more. Subscribe and listen in for new episodes and enjoy the show.
All right, Ariel, welcome onto the show. Excited to have you.
Thanks for inviting me.
Absolutely. So there's a lot of stuff that I want to talk with you about today. And, you've done some really things, both in terms of international investing, working and investing in some, very large brand name companies at a very early stage. But for those of the listeners who are not familiar with your background, just before we really dive into things, would you mind giving me an overview of yourself and your background and how you got to where you're at today?
Yeah, definitely. I'll try to keep it brief, but born and raised in New York City. My family's from Argentina. Studied industrial engineering in undergrad. Started my tech career, I guess you can say, at Intel Corporation, when once upon a time it was one of the more exciting companies in Silicon Valley. And then I've done a pretty random variety of things. So I did that for a few years. And then after getting my MBA, I worked briefly for the United Nations Development Program in Venezuela. I worked in strategy consulting for a couple of years at a group that was within Bain called the Bridgeband Group that works a lot with nonprofits, foundations, governments, etc. And then I joined one of the pioneering impact investment firms after I realized that consulting definitely wasn't for me. Worked there for a number of years, investing in a mix of companies. Most of them were consumer facing, some were tech, some were non-tech. And then, I think ever since, 2015 or so, I've been pretty focused on Brainstorm Ventures, which I'm sure we'll get into, but that's our super early stage, super industry agnostic venture capital firm that we're currently investing out of its Fund 3.
Oh, so you're at Fund 3 already. Nice. Tell me a little bit more about Brainstorm, because I like you mentioned you've kept it small on purpose and you've kept it industry agnostic, and oftentimes VCs, especially when they are a little bit smaller, they tend to specialize in, call it, 2 or 3 niche areas. I was just curious, what's behind the decision to remain industry agnostic?
Yeah, I mean, even in terms of staying small, right? I think most VC firms, once they're able to achieve a certain degree of success, they try to grow their assets under management, try to increase the size of their subsequent funds. For us, to your point, both staying small and staying industry agnostic is really core to our strategy, and that's for a bunch of different reasons. In terms of staying small, for us, being able to write small initial checks really helps us get into some of the more competitive space-constrained rounds that we're looking at. In many cases, we're investing in founders before there's a round being formed, so that's not an issue. But in a bunch of cases it is, and staying small helps us get into those deals. Might be a little bit controversial, but another benefit for us staying small and writing small checks is that it minimizes the signaling risk when we're not participating in follow-on rounds of some of our portfolio companies, so that we can really concentrate our follow-on checks into those handful of best performing portfolio companies and concentrate our positions there without adversely impacting our other portfolio companies. So that's another important reason. And then I would say that I think it keeps us a little bit more economically aligned with our LPs. We're clearly not getting rich off of management fees. And then the last thing is, it's not a reason for us in particular, but I think the data out there suggests that smaller VC funds tend to outperform larger ones in aggregate. Obviously, there's a huge variation from fund to fund, but that's kind of something to keep in mind as well. As far as being industry agnostic, also several reasons there. One is that it allows us to invest in really the best deals that arise from our network, regardless of what industry vertical or type of technology they land in. We really view ourselves as a firm that invests in networks as opposed to investing in particular theses or obviously our industries or even technologies. Another reason that's a little bit particular to us is that it allows us to diversify away the sector risk within each of our funds. And that's important for us in particular because many of our LPs are high net worths or small family offices who have very small fund portfolios. So, from the point of view of a large institutional investor that's investing in 50 funds, us being diversified from a sector point of view adds no value to their portfolio strategy. But for the majority of our LPs, I think it's important that if one of the sectors we invest in goes to shit, call it blockchain, that's not going to actually affect our fund too much as a whole. So I think that's important. And yeah, I would say the other thing is, I rarely invest in, a thesis that I have in my mind for what the world will look like. And this kind of goes to the being agnostic. Instead, I really rely on a founder to convey their vision for what they think the world will look like that, in many cases I've never thought of before. And we're betting on their vision, not our vision. So I think that's a key component to the agnostic piece as well.
Super interesting. And there's so many things that you said there that I want to dig into further. And I'm probably not going to remember all of them off the top of my head, but I'm going to do my best here. So on the staying small side, just for context, you mentioned you're on fund 3 and that you remained relatively small throughout the fund. So if you don't mind me asking, what are the fund sizes of, say one,
Yeah.
2, and 3?
So funds 1 and 2 were slightly less than 10 million each. Fund
Okay.
3 is at 15 million. We'll start raising fund 4 next year, and we won't exceed, call it 25 million by any stretch of the imagination. So that's what we mean by small, pretty small.
Okay. And so then what are the initial checks that you're typically writing for first investments, not
Yeah.
follow-ons?
So I would say on average it's about 250,000.
Okay. And then you mentioned that you don't want to write too big of checks also so that it's not too large of a signal for, potential follow-ons. Just curious, how frequently or what percentage of the time are you doing a follow-on investment
Yeah.
from an initial?
Yes, and I think the signaling risk has less to do with the checks that we ultimately write in the follow-ons and more to do with the fact that since we're this small pre-seed and seed fund for the most part, there's no expectation that we're going to be playing a role in our portfolio company's Series A. So when we do choose to participate in the Series A, great, and we can do so in a concentrated fashion, a large check for our relative size. But when we don't participate in the Series A, the new investors that are coming into that are leading that Series A, they're not going to ask, oh, why isn't Brainstorm participating? It's like, no, Brainstorm's this little fund. They did our pre-seed and or our seed. Because we're small, there's no expectation that we'll be in those Series A's, for example. I think we tend to do meaningful follow-ons, and let's call it 3 to 5 of the companies in each fund's portfolio. And just for context, we typically invest in about 25 companies per fund.
Okay. So math-wise, about 10, 15%.
Yeah.
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 Okay. So really when you're talking about signal, what you're looking for is to avoid it being seen as a negative signal, that it's like you don't have faith in the founder and it's like, no, we kind of did our part in what we were meant to do.
100%. Exactly.
Got you. Okay. I'm just curious. I mean, of course, particularly at the pre-seed level, it's such a large risk. I mean, what are you even really looking for at the pre-seed? Are you expecting that they have a working MVP? Have you ever funded? We have this really good idea and some good signals. What does that look like for you in terms of your process?
Yeah. Yeah, and obviously connecting this question to your prior one, I think that our strategy really diversifies away a lot of the risk at the fund level, but at the individual company level, you're 100% right. At the stage we invest in, we look for strong founders and founder market fit first and foremost. What is that, right? It's kind of demonstrated ability to be able to hustle, to be able to hack. It's important for a founder to be able to distill a complex problem down into layman's terms. Again, we're agnostic, we're not experts in every sector, and really succinctly tell the vision and solution in a compelling way. So that's something that, obviously comes across in those first meetings. In terms of founder market fit, which is, critically important, it doesn't only mean, this nuanced understanding of the problem because they've spent years in industry, but also the experience necessary to solve it, right? Whether that be technical, having the right industry contacts, et cetera. And I think as most folks, we love seeing repeat founders and co-founders with a history together. It's a little bizarre, but I think 2 of our current portfolio companies have co-founders who are married to one
Oh,
another.
really? Oh, wow.
Yeah.
Okay.
Which I think is probably statistically above the majority of VC firms out there. But being a repeat founder isn't necessary. Um, and then there's the other things that folks typically look for, right? We want to see an opportunity to um, build a huge business with strong unit economics, so that if successful, the company can scale efficiently and become very profitable one day. Therefore, the market has to be large or become large in the next 5 or 10 years. And ideally, the product or service that the startup is offering is an order of magnitude improvement over the status quo, right, that exists today. I would say given the stage at which we invest, we want to believe that there's the potential for a 100x return in each investment if everything plays out as well as possible. We think about it from that point of view instead of having specific ownership targets in mind. For example, this outcome could look really different for a company in which we invest at a 3 million valuation in the initial round versus one where perhaps we came in at a $40 million valuation in the initial round. And in terms of our due diligence when we're evaluating investment opportunities, what we try to do to be efficient is to identify and get comfortable with what we perceive to be the really small set of key risks that would prevent that particular company from achieving this type of 100x or unicorn type outcome. And really honing in on those instead of doing a blanket due diligence on every aspect of the company. So yeah, that's kind of how we approach investing and how we think about risk at the stage at which we're investing.
So to press back a little bit on the industry agnostic component, of course that does diversify your risk, as in, like you said, if blockchain goes to shit like it did in 2022, then your whole thesis is sunk. But doesn't that give you some sort of limitation in terms of how well you can evaluate what that market will look like in the next 5 to 10 years? Because naturally the founders are going to be optimistic. That's why they're founders, right?
Yeah, I would say good question. I mean, in cases in which we're further removed from the particular technology or industry, we lean pretty heavily on what we think is a really strong network of folks that we're really close with and have built relationships over the last 2 dozen years. And they help us assess those types of questions. Because yeah, clearly our personal opinion on, we're invested in and currently doing an SPV in a really novel, groundbreaking gene insertion biotech company that's kind of at the intersection of computational bio, machine learning, and biotech. My opinion on where that space is going means little to nothing. So yeah, we we lean in on folks that are close with us, right? And that's what helps us get there.
So important to just have a strong advisor network.
Yep. Yeah,
And
both
and
formal advisors and informal, 100%.
Okay. And then do those folks just typically come from your network? Are they LPs, other founders you've gotten to know over the year?
Yeah, it's a mix. It's our network, right? But what our network really means is it's peers, other VCs that may be focusing on those spaces, founders that we've previously backed, that they themselves understand those spaces or know folks that do, and just folks that are, leading really, really interesting organizations across a variety of different segments of the kind of broader tech ecosystem.
Gotcha. How do you approach it when, let's say you meet a really good founder and they seem to have that founder market fit that you're looking for, but you think the model is not bad, but, maybe not the best. Let's call it a, 6, 7 out of 10. Is that still something you'd consider investing in because of the founder themselves, or what do you look like from that perspective?
Yeah, I mean, I think my cop-out answer is that it depends on how kind of demonstrably great the founder is and how, mediocre or, decent the business is. I think the devil is really in the details and kind of how well the founder can make that case. Um,
Yeah,
so,
that makes sense. That makes sense.
in that case, one of the risks that we would identify is, shit, this market doesn't seem that attractive either because of size or competitive landscape or kind of inherent economics or what have you. How can we get comfortable with what the founder is trying to portray, right?
I guess, and also there's also the thought that if there, is a mediocre to semi-good business opportunity, how great is the founder if they're pursuing something that doesn't seem that great? Does that speak to their decision-making skills?
100%. That's exactly right.
So when you're talking about the investments, and you mentioned 100x earlier, which is, really what you would be looking for in an ideal scenario, how many, on a percentage basis, how many do you expect to actually hit that threshold?
Yeah, it's if 100x, we can return a fund several times over with one or two investments in our portfolio of 25 that reach those types of returns. Um, Anything more than that is, obviously icing on the cake. I think,
Sure.
it kind of depends from fund to fund. There could be one fund where we have a bunch of 10 to 30x returns. There could be one fund where we just had one 200x return and the rest of the portfolio didn't perform that well.
Yeah, well, and I think too, the other thing that people often think about when they think about early stage VC is that it's all or nothing. It's either you hit that 100x or it's a total loss, right? And I'm sure there are,
Tons.
plenty of total losses in the portfolio, but then you also have those companies that get to say, the Series A you mentioned earlier, the Series B, and then things may not go quite as planned, but then they do get a buyout or an acquisition level at that offer, and you still get some meaningful return.
Yeah, obviously, at the point of investment, we're always like shooting for these home runs, but the reality is that you're happy when, several of the companies in your portfolio end up getting these doubles or triples, especially if they had to overcome, adversity, difficult situations, and they still manage to have a pretty good outcome, right?
Absolutely. And you have hit some home runs. I mean, you backed unicorns, you've backed Open Table, Zappos in the early stages, Turing. I'm just curious. I mean, are there any common traits that you saw when you were doing that early stage investing that you felt like, yes, this is the one?
Yeah, good question. I think in those cases, the common traits are really that, you know, Chuck Templeton at Open Table, Tony Hsieh at Zappos, and both Jonathan and VJ at Turing were all proven strong operators with a really clear vision for where they saw the world going. In the case of Chuck, he was literally an operator as an Army Ranger
Mm.
prior to founding Open Table, which at the time was called Easy Eats. This like we have to kind of go back in time to a period when reservations were done by pen and paper. He saw a really interesting opportunity to disrupt this huge restaurant industry with software, beginning with managing the reservation process that restaurants have to do, and then with Tony Hsieh, who as I'm sure sadly passed away 4 years ago next month actually. He had really rolled up his sleeves as a fellow board member at Open Table.
Mhm.
And so we saw kind of his operating ability there. And he had this novel vision for Zappos at the time that involved, not carrying inventory, and offering really incredible customer service for an e-commerce play, like Nordstrom's at the time, and still does, I think, offer in its brick and mortar locations. And now it sounds really trivial, but at the time, this kind of relentless focus on the customer and servicing them didn't really exist in e-commerce. So we bought into his vision there, and we knew what his kind of operating skills were. And then with more, much more recently with Jonathan and VJ at Turing, they had previously founded another startup called Rover, which they exited, and where they actually used engineering talent overseas to scale that company more efficiently. And that was their inspiration for Turing, which, as you
Mhm.
may know, is kind of completely AI-powered platform to assess, match, onboard, and even manage top-tier remote software engineers for what is now like a very long list of Fortune 100 customers. So yeah, I would say those are the kind of, if you had to some kind of find commonality, those would be the two traits. It's the operating skills and the clear vision.
Yeah, well, and it's funny you mentioned that the focus on the customer and e-commerce seems like table stakes, but isn't that really just what a lot of unicorns do is take something that at the time is novel and grow it so successfully that yes, it then becomes just part of the public consciousness. Like, of course, I can reserve a reservation on my phone. Why wouldn't I be able to?
Yep.
I actually did not know. I know what Turing is. I'm familiar with it outside of doing research for the podcast. I did not know that the founders of Rover were also the founders of Turing. So
So
that's interesting.
it was a company called Rover AI.
Oh,
It was
Rover
an
AI. Okay.
AI recommendation engine, not a dog
Not the
walking.
dog, not the dog walking app. Okay, I was
Yeah,
going to say those are two
I should
very
have
different
clarified.
things. Good to know. Okay. So you also then count, and obviously, second time founder is great. You mentioned earlier, first time that they don't have to be. And over at Open Table, his background was an Army Ranger. So it doesn't necessarily have to be, company operating experience like BizOps or something like that, but something where expectations are high, you have to perform at a high level and for a consistent period of time.
Yeah, although, just realistically, the overwhelming majority of folks we see have much more quote unquote relevant operating
Of
experience.
course.
But yeah,
Yep.
yep.
Well,
We
I
try
love
to
that you can
be
see the potential.
open-minded. Yep.
Awesome. Switching gears a little bit, you don't just invest in US based startups, you also invest in Mexico City based startups or Mexico based startups. I was just curious, where did the inspiration for that come from? And how is the Mexican VC ecosystem?
Yeah, good question. So I'll preface it by saying that, we've been investing in Mexico on and off since 2000, believe it or not. I think that makes us the first kind of US Mexico cross-border VC firm out there. We wrote the first check in Mexico's first unicorn, this company called Keo Networks, where we actually played a role transferring the initial technology that Keo Networks was based on from a company in our network in Silicon Valley. My partner, Eduardo Rayo, grew up in Mexico, that studied in the US and spent most of his adult life in the US, but grew up in Mexico. My family, as I mentioned earlier, is from Argentina, and randomly kind of over the years that built kind of an interesting network of folks in the tech space in Mexico. So that's a little bit, why we continue to invest in the ecosystem on top of a bunch of reasons for which we're bullish about Mexico specifically, and also honestly Latin America in general. So some of these things your listeners might know, some they might not, but Mexico is the world's most populous Spanish-speaking country. Mexico City is the world's most populous Spanish-speaking city and one of the world's top, yeah, it depends, I think, how you measure it, but handful of cities in the world population-wise. Very high digital penetration. I think Mexico City is Spotify's largest market in the world, and
Oh, really?
Mexico country is Uber's second largest market after the United States. Obviously, Mexico shares this 2,000-mile long border with the United States, and I think roughly 10% of the US population is of Mexican descent. We're currently experiencing this really interesting and exciting near shore shoring momentum with everything that's happening with China. I was actually at an event in Mexico City a couple of weeks ago with Ken Salazar, who's the US ambassador to Mexico, and he told us that Mexico just surpassed China as the United States' largest trading partner,
Really?
which is interesting. Honestly, I think some of the growth in trade is actually from Chinese companies who set up shop and manufacturing facilities in Mexico to both avoid tariffs and take advantage of NAFTA, or I guess now it's called USMCA, but still, directionally, things are moving in the right direction. And, this is more at a regional level, but despite the growth of the startup ecosystem in LATAM, which, we've experienced firsthand over the last, 5 or 7 years, there's still relatively low VC investment as a percentage of GDP in the region as compared to similar regions like Southeast Asia is the one that comes to mind. Yet Latin America has had more success cases than Southeast Asia or some of these other regions that are comparable. So I think there's still a, really important opportunity for VCs in Mexico and Latin America. Another thing that I've noticed is that, in the early days, what would happen is you would see a lot of founders in Mexico, and I think this is true for Latin America as a whole, that were basically tropicalizing models that worked in the US and just applying them to their domestic market in Mexico, and just fine-tuning the model based on the realities of being on the ground in Mexico or in Argentina or what have you, instead of in the US. More and more, which is makes me proud is you're seeing founders still do that, but you're seeing a lot of founders that are actually building companies in Mexico and Latin America now that are innovative worldwide, and they're competing on the world stage, and they just happen to be companies that are based in Latin America, but they're competing with players around the world. And I think that's been, kind of a strong indicator of their ecosystem, really progressing. So it's been great to see.
You mentioned that there's been less activity despite more GDP in Mexico as opposed to Southeast Asian countries. Why do you think that is?
I don't know. I mean, I think part of it might be that I don't really have a good answer for that. I mean, I think there's people view Mexico and Latin America as having a lot of political risk. I think naturally a lot of the dollars that would go into Mexico, for example, would come from the United States, but the United States has, this huge, vibrant tech ecosystem of its own. Whereas maybe in Southeast Asia, there's more wealth nearby that, they don't have as many alternatives for where to invest that capital as, money in the US would have. That's just kind of a hypothesis.
Is there a language barrier at all, or do most of the founders tend to speak English in Mexico?
Most of the founders speak English. Yeah, and honestly, and culturally, I think when you compare the US to Mexico, culturally they're so much more aligned than, there's a lot of US based and Sand Hill Road based VC firms that invest a lot in, or historically have invested a lot in Israel, in China. That's kind of
Yep.
kind of come to a halt. Culturally, time zone wise, etc. There's just so much more commonality with Mexico and Latin America, that I think that's a non-issue. If anything, I think that's a reason to invest in Latin America.
And do then most of those, I know you mentioned some of the startups are now competing on the world stage, but would you say most of the Mexican startups are servicing the Mexican population, or what percentage of them tend to go,
Good question.
international, that SaaS products, anyone can use it?
Good question. I think most of them are still targeting the Mexican market, but I think there's step one is the Mexican market. Step two oftentimes is becoming market leader in Latin America, whether that be Spanish speaking Latin America or Latin America, including Brazil, which is kind of an animal of its own, but obviously a huge market. But increasingly there are companies in Latin America that, and some of them are in deep tech, for example, that are from day one targeting the global market. I think that's one place where Mexico might be at a slight disadvantage of, let's say, in Argentina, where, Mexico in and of itself is an attractive enough market where a lot of founders just view becoming the market leader in Mexico as a win. Whereas countries like Argentina, or, basically all the smaller countries in Latin America, have a mindset that's a little more similar, I would say, to Israel, where they know that their domestic market is small. And that so from day one, they're building for a global audience, because they can't, achieve, a significant success just from being a dominant player in their local market.
It's like if you're the number one in Ecuador, it's like you're the biggest kid in the neighborhood, but not.
Yeah, exactly.
Okay.
So that actually works as a little bit of a disadvantage to founders in Mexico in some ways versus founders from smaller countries, but it is what.
Super interesting. Okay, so that's the opportunity. What are the challenges from an
Yeah,
investment standpoint?
I mentioned it before. I think there's always currency risk. For us in particular, where we're more focused on Mexico. And I should say, in each of our funds, I would say, 75 to 80% of our portfolio companies are US based, and then the remainder tend to be Mexico based. But I would say that, for the Mexican peso in particular, it's been relatively stable versus the US dollar for the last 8 years or so. So we don't view that particularly as a risk, but I think other folks do. I think it's important in order to be able to get into the most interesting deals, it's important to put in the effort, obviously, and invest the resources to maintaining and growing a presence and a network in country, right? And then, I will say that things have gotten more competitive in Mexico with the entrance of many US and Sand Hill Road based VC firms over the last 5 years or so, given a lot of the reasons that I gave before. But, obviously on the flip side, that's a great development for Mexican founders. And I think it's great for the ecosystem overall. Another challenge that not only affects Mexico, but I think affects Latin America as a whole, and probably all kind of developing ecosystems, or most, is there tends to be a lack of growth capital. So you tend to see a lot more early stage funds in the early days and less growth stage funds that can kind of take those companies from, beyond the Series A. That's changing slowly in Mexico. And I think with this kind of interest over the last 5 years or so from US-based firms, that's another source of growth capital. But there have been, kind of new local growth stage VC firms that have kind of arrived on the scene over the last couple of years, which is a great development. But that over time, historically, that's been an issue, is access to growth capital for some of these Mexican and Latin American startups.
And when we're talking growth capital, just for the clarification of anyone listening, so it's, they can raise their pre-seed or seed fund round from you, but when it comes to getting that Series A, Series B, Series C, et cetera, then that's where the major challenge comes in.
100%. I would say it's particularly Series B and beyond.
Gotcha. Okay. To switch gears a little bit again, so the story of me.com, it's an interesting story in the sense that it was wholly owned and then eventually transitioned into what now has become known as iCloud. Tell me the story about that. I'm very curious to know.
Sure. You did your homework. Yeah, I mean, me.com is kind of a somewhat unique case in which we incubated the company as we did with Keo Networks, but where we did own it outright, unlike Keo Networks, where the company raised, a bunch of outside capital. We initially owned the domain name. We brought in someone from our network named Mac Tilling to build me.com into what at the time was kind of like an online repository for users' personal information. And then Apple eventually reached out to inquire about acquiring me.com. But, without saying that they were Apple, we think, that was to avoid us raising the asking price. So, fortunately, Mac eventually figured out it was Apple, and we ended up selling for a good price. And, the rest is history. We can't take any credit for it whatsoever, but, to your point, it eventually evolved into what is today iCloud. But it's nice to have played a small role in the creation of iCloud. We actually still have LPs and kind of folks within our network that use their me.com emails, which is always fun to see.
Really, I still see a few of those occasionally.
Yeah.
What was it like? I'm gonna pause here. If you want me to not ask this question, I was going to ask like what was it like being on the M&A process side, like as like the seller as opposed to the VC? Do you want to avoid that or?
Oh, yeah. Beyond what I said, I wouldn't say anything.
Okay, all right, we'll cut this out. Okay, all right. Sorry, I'm just gathering how to mentally take it back and kind of change the subject. Yeah, well, that's super cool just to play a small part of history. I love that. And then a little bit outside the scope of what we normally talked about on this show, but you're also the treasurer and you're on the board of DeFi Ventures. And I looked it up, did some research. I absolutely love the mission of what you're doing. Could you tell listeners a little bit more about what it is and your involvement in it?
Yeah, I'd love to. Thanks for asking. So DeFi Ventures provides entrepreneurial training to people who are incarcerated. The premise is putting the hustling skills that many folks that are in prison possess to good use and to in turn reduce recidivism and create economic opportunities for both them and their often underserved communities when they're eventually released from prison. So some end up making the business plans that they worked on during the DeFi Ventures programming a reality once they parole and become entrepreneurs. Others, they gain employment, often with the help of DeFi Ventures, but end up applying the kind of the skills that they learned through DeFi Ventures to being more intrapreneurs at the companies or places at which they're hired. And either way, we see that as a win. I've been on the board since 2019. Honestly, the leadership team did a outstanding job navigating a tough couple of years after I joined the board during the pandemic, where a lot of kind of in-person programming at prisons was shut down, as you can imagine, and things got pretty tough. If you think that folks on the outside had it hard during the pandemic, yeah, it was hard.
Well, I love that mission because I just think it becomes such a catch-22 when people get out of prison. It's like, okay, well, you want to avoid, you know, doing something wrong and having to go back, but then also no one wants to hire you because you
Yeah.
were in prison. So it's like, how do you support yourself
Yeah.
except for
Yeah.
the, perhaps involvement in the previous activities that got you there in the first place?
Yeah, no, 100%. Fortunately, we have a growing number of kind of fair chance hiring partners that, see the value in hiring these folks, and we're able to make these connections to get gainful employment. Um, but yeah, I mean, honestly, after the pandemic, Defy Ventures has been killing it. They're in 7 states, including California and New York, rapidly growing within those states, and also looking to expand to new states. So yeah, things are on the up and up. Super passionate about it, and yeah, they're doing really good work. Barack Obama actually lauded them back in the day,
Oh, really?
which was yeah, yeah, yeah. So
That's awesome. Well, Ari, this has been a super good conversation. I've really enjoyed it. If someone wants to get in touch with you, either, to pitch or to potentially invest, what's the best way for them to do that?
yeah, I would say via LinkedIn is probably the easiest. I'm getting better and better at replying to messages on there. So whether it be regarding Brainstorm Ventures or Defy Ventures, please feel free to reach out on LinkedIn. I actually don't have social media. I've never had social media, not even Twitter. So I think that's the best way.
All right. Awesome. Sounds like a plan. Well, again, thank you for coming on. Really appreciate it.
Thank you. Thanks for having me.
Thanks for listening to Seed to Exit. If you enjoyed the episode, don't forget to subscribe, and we'll see you next time.